Hi guys, welcome back to my channel. Kelvin here. Recently, AXS Investments launched 8 single stock ETFs. And yes, you are seeing it correctly. One of them is Short Tesla ETF, TSLQ. Which means that if you are a Tesla bear, this is a dream come true. Because now, you can buy this ETF and when Tesla crashes to $0, you will hot big. Okay, I can tell that you are super excited to buy this ETF right now. But before you go and YOLO all your money into these ETFs, you need to know that investing in this ETF is dangerous. As dangerous as driving a car to Malaysia. Because you don't know who might come and tear off your car number plate. So, in this video, I want to share the pros and cons of investing in single stock ETFs. Then share a few better alternatives that are less risky. But before I start, I would greatly appreciate it if you can help to tap the like button and subscribe if you haven't done so. In return, I will show you a lazy hamster. Alright, let's start right now. Okay, let me give you a quick intro to all these ETFs. There's the bear and bull ETFs where you will earn money depending on whether the stock goes up or down. Then for some ETFs, you will notice that there's leverage. For example, 2x Nike Short ETF, where if the stock goes down by 10%, this ETF will shoot up by 20%. If you are curious how single stock ETFs work, basically, it's by using a derivative called swap. I won't explain what is a swap in this video because it's complicated. If you want to know more, you can just read out yourself. Now, the reason these ETFs exist is because there's demand for it. And AXS Investments be like, might as well create these ETFs for them and profit off the fees. For example, many people like to short Tesla because they feel it's overvalued. Even Bill Gates, one of the richest men on earth, is also shorting Tesla. Okay, let me share 2 benefits of investing in these ETFs. First, alternative to shorting. Traditionally, when people are bearish about stock, they will go and short the stock. But when you short stocks, you might encounter a few issues. One of them is you need to borrow stocks in order to short. And for that to happen, there needs to be stocks available for shorting. If you check the short interest chart, float is the amount of stocks that's available for borrowing. And short interest is the amount that's being used for shorting. Here, for Revlon, we can see that there's 23% remaining stocks that can be borrowed for shorting. So, if there's no more float, then you won't be able to short the stock. Then, when you short stocks, there's also a margin requirement. For example, if you want to short Tesla on Tiger Brokers, there's a 35% short initial margin requirement. If the stock suddenly shoots up, you will easily get margin called. On top of that, you will need to pay interest when you are borrowing stocks for shorting. Typically, it's around 0.3% to 3% annually. Meanwhile, inverse ETFs don't have all these issues. You don't need to have margin to short, you don't need to pay borrowing fees, and you don't have to be worried about available float. All you need is money. Then you can start shorting. Second, higher returns. Most of these ETFs are leveraged, meaning you will get higher returns if you turn out to be correct, of course. For example, if we compare QQQ to TQQQ, a 3S leverage ETF from 2011 to 2021, QQQ gave 553% return, while TQQQ is all the way up there on the moon, giving over 9,000% returns. This is also true for inverse leverage ETFs like the 2S Pfizer Bear and 2S Nike Bear. If the stock drops by just 5%, you will already get 10% return. So, by investing in leverage ETFs, your gains can be amplified. Quick pause. Webull is the latest stockbroker in Singapore. With Webull, you can now buy US stocks, US options, and Hong Kong stocks for a low fee of $0. Yes, that's right. It's zero commission trading. Webull also supports fractional shares. So, you can now buy stocks with just your $100 Ang-Bao money. But the most important question is, what's their sign-up gift? If you sign up now, deposit at least $1,965, make 6 buy trades on either US stocks, ETFs or options, you will get $100 worth of free Google shares. This promotion ends on 1st September, yeah? So if you are interested, you can sign up with my link down below. With that being said, let's get back to the video. Okay, those are the 2 benefits of investing in single stock ETFs. But now, let's talk about the downsides. First, high fees. Normal ETFs like the S&P 500 ETF, CSPX, has a very low expense ratio of just 0.07%. Meanwhile, single stock ETFs have a very high expense ratio at 1.15%. In other words, for every $1,000 you invested, $11.50 is being used to pay the fund manager, and the fee will eat into your profit. But the biggest problem of these ETFs is that the returns can decay. Let me explain. If Tesla goes down by 5%, TSLQ will give you a positive 5% return. So you hope big, right? Yes, but check this out. Here, I'm comparing the performance between a normal stock, a 1x inverse ETF, and a 2x leverage ETF. So let's say Tesla is $100 right now. Just an example, yeah. I'm not saying that Tesla will crash to $100, yeah. On Monday, Tesla drops by 20% to $80. So the inverse ETF goes up by 20% and the 2x ETF goes down by negative 40%. So far, so good. But now comes something interesting. Over the next few days, Tesla slowly goes back up, and by Friday, it went back to $100. Basically, no profit, no loss. By right, you would expect that the ETFs to go back to $100 also, right? Well, yes, but no. On Friday, the inverse ETF ends up at $94, basically down by 6% since Monday. And the 2x ETF ends up at $92, down by 8%. Why like that? That's because of mathematics. If the stock drops by 10%, it needs to go up by 11.1% to break even. So even if the stock recovers back to its original price, the inverse ETF will end up with a lower return. This is even worse for leverage ETFs, where the gains and losses are amplified. Take for example, from 2011 to 2016, MSCI China ETF is down by 18.4%. So you would expect to make money on inverse ETF, right? Turns out the inverse ETF is down by a lot more. Also, remember the QQQ versus TQQQ example? TQQQ was giving super high returns because during that period, we had the best bull market ever. If we were to compare the performance from 2020 till now, after the crash in November, TQQQ is actually underperforming QQQ. In fact, that's the general direction of these ETFs. Over the long term, they will trend downwards. AXS knows this well. They've warned us that for periods longer than a single day, the funds will lose money if the underlying stock performance is flat. And it is possible that the fund will lose money even if the underlying stock performance decreases over a period longer than a single day. And even though the SEC has approved these ETFs, they also want that they are risky products. They be like, own self be careful. In short, you shouldn't hold these ETFs for too long because their return can decay even if the market is flat. Instead, they are only suitable to make a quick short-term bet. Like maybe you think that Tesla will miss earnings and crash super hard. Then you can gamble, invest in this ETF for one day. Third, risk losing everything. This risk applies to inverse ETFs and especially for stocks like Tesla, where it can suddenly shoot up very fast. So we already know that if Tesla drops by 10%, TSLQ will go up by 10%. No problem, right? But what if Tesla has a super good news? Like maybe it's full self-driving. Tesla might, probably, maybe, possibly shoot up by 100%. We have seen this kind of returns in the past, so it's definitely not impossible. But if Tesla goes up by 100%, what happens to TSLQ? Basically, it will go down by 100%, aka you lost all your money. In summary, by investing in inverse ETFs, you risk losing everything if the stock shoots up. Okay, now that you know that investing in single stock ETFs is risky, if you still want to invest in them, can is can. But let me share some ways to reduce your risk. First, stop loss. Investing in single ETFs will definitely be a short-term trade, and all traders will tell you this. Always use a stop loss. So let's say if you're aiming for a $5 return, then you can put a stop loss at maybe negative $10 loss, so that you won't end up losing everything and make your wife angry and run away. Another way is to use trailing stop order. Basically, if the stock goes up, your stop loss goes up together. But if the stock drops, the stop loss stays there. This means that if you are profiting, trading stop loss will try to maximize your profit. Some brokers like IBKR, Mumu, and Tiger Brokers has this, so be sure to use them. The second way is slightly more advanced, options spread. One example is a bear put spread, where you are betting that the stock will drop. Basically, you buy a put option, then sell another put option at a further strike price. You get a bear put spread. Your profits will be limited, but your losses are also limited. Instead of using inverse ETFs, where you risk losing everything, this is a much safer way to bet that the stock will fall. Or if you want to bet that the stock will rise, you can use a bull call spread, where your losses and gains are defined. Third, do nothing. Personally, I would recommend you to not even touch these ETFs. Sure, by investing in them, you can make a bit of money here and there. But over the long term, these tiny profits won't even make any difference in our lives. At most, you can only use it to buy some chai fan. That's all. Meanwhile, you are risking losing your money because it's super hard to tell where the market is going in the short term. Unless you are hardcore, then you can tell. Personally, I prefer to just preserve the cash and use it to buy the dip on good stocks, which is a much more guaranteed way of earning money. Anyway, that's all for today. Are you investing in single stock ETFs? Do comment down below and let me know. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.